Can the ICICI Pro Platinum Plan adapt to your unique financial goals and provide better returns in the long run? Let us find out through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a linked non-participating individual savings life insurance plan. Some of the key features of the policy are you get to select from 2 life cover options tailored to your life stage and requirements, and you can also enjoy monthly payouts for supplemental income needs with the systematic withdrawal plan, and you can boost your savings with the top-up feature to align with your changing financial goals, and you can also benefit from a cost-effective structure with no premium allocation charge, and you can grow your wealth through market-linked returns with access to 22 fund options, and you can avail tax benefits on premiums paid and benefits received, which are subjected to prevailing tax laws. So these are some of the features of this policy, and there are benefits like maturity benefit and death benefit. And there are 4 investment strategies available which you can choose based on your investment strategy, which will be suitable to your goals and risk tolerance. And there are also 25 fund options which are listed right now, presented on the screen before you for your easy reference, which you can pause and see. So in this tabular column, we have categorized these fund options based on the percentage of asset classes. Based on the percentage of allocation, each fund option has to asset classes like equity and equity related securities, debt, money market and cash. And also it has been categorized according to the risk profile each fund option has. So you can choose whichever fund option suits your investment objective and risk tolerance. And this policy also charges you with multiple charges before investing your premium, including premium allocation, discontinuance, mortality charges, which persist throughout the policy term. So in contrast, other market linked products typically have lower charges and offer more transparency in their investment processes. So these higher charges in ULIPs can significantly affect your returns over time. So now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are you get to choose to receive the maturity benefit as a structured payout or as an income stream for up to 5 years after maturity, and you can add extra funds to your plan with the top-up premium feature and make partial withdrawals once the lock-in period is over. And you can also use the systematic withdrawal plan to regularly withdraw a fixed percentage or amount from your fund value, and you can even adjust the frequency of your premium payment at your convenience. With no premium allocation charges, your entire premium is invested in the fund of your choice. So these are some of the advantages of investing in this policy. However, the disadvantages are this plan has a 5-year lock-in period for surrenders or partial withdrawals. Loan facilities are not available under this plan. Fund options are also not distinctive enough and often have overlapping investment strategies. Premiums are invested only after deducting multiple charges. The fund value becomes accessible at the age of 70 or 75 depending on the chosen plan option, resulting in an extended policy term. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of this policy, let us move on to the analysis part of the video, where to make an informed decision, we are going to calculate the IRR of this policy, which is the internal rate of return based on the benefit illustration given in the policy brochure. So for calculation purpose, let us consider a 35-year-old male has chosen to purchase this policy with a sum assured of 15 lakhs. The annual premium is 1,50,000. The policy term is 40 years and the premium payment term is 20 years. So here we are going to calculate at 2 gross assumed returns, which is 4% and 8% per annum, just to indicate the worst and best case scenario this policy can perform in. These are not guaranteed returns, or these are not the only maximum or minimum returns this policy can earn. So the actual fund value will depend on factors like future investment performance. So this is just for example purpose, just to see how this policy can perform in both extremes of the spectrum. So in the worst case scenario, at an assumed 4% return, the fund value is 58.71 lakhs, resulting in an IRR of 2.20% as per the policy's maturity calculator. At 8%, which is the best case scenario, the fund value grows to 2.02 crores with an IRR of 6.24% as per the policy's maturity calculator. So the potential returns from this policy are lower than those from the traditional debt instrument. So this defeats the purpose of a market linked investment, slowing wealth accumulation and potentially causing a financial shortfall. Consequently, investing in the ICICI Pro Platinum plan could derail your financial goals. So now, as this policy is not giving us the desirable outcome that we need, we are going to explore an alternative strategy for a comparative analysis, where in this strategy we are going to invest in investment and insurance separately, just to see whether it can perform efficiently when invested separately instead of investing in a bundled product like the ICICI policy. So here, for life cover purpose, we have assumed to be invested in a pure term life insurance policy with a sum assured of 15 lakhs, which costs 25,200 rupees annually as a premium for a 35-year policy term and a 10-year premium payment term. So this leaves us with 1,24,800 from the original annual premium budget we had for ICICI policy, which is of 1,50,000 rupees. So this can be invested separately to achieve higher returns. Unlike the 20-year premium payment term in ICICI policy, the pure term policy has a 10-year payment period. For the first 10 years, the balance after paying the insurance premium is invested. In the following 10 years, the full premium amount is available for investment. So selecting the right investment avenue based on your risk appetite is essential. So if you are a high risk investor, you may prefer equity, while if you are a low risk investor, you might choose debt instruments. So here's how these investments have performed over 40-year time period. So based on the calculations presented in the tabular column, in the debt scenario, which is if you choose to invest in PPF, the maturity value in a public provident fund at the end of 40 years is 2.33 crores, delivering an IRR of 6.71%. However, as a debt instrument, PPF can potentially outperform the returns of a market linked product if you take in the returns of the ICICI product. So in the equity scenario, suppose if you choose to invest in equity linked savings scheme ELSS, it yields your corpus of 10.19 crores after 40 years. Even after deducting capital gains tax, the post-tax value remains 8.93 crores with a post-tax IRR of 11.12%. So if you have any doubts regarding how the ELSS tax is calculated, we do have a small tabular column presented on the screen for your easy reference, which you can pause and see. So this approach offers you two key advantages over the ICICI policy. One, higher returns, which is the alpha generation. Second, liquidity. So this comparison clearly demonstrates the combining insurance and investment compromises both returns and liquidity, making it less effective in achieving financial goals. So what is the final verdict? Is investing in the ICICI Pro Platinum policy worth it or not? So under this policy, you pay premiums for a limited period and the fund value becomes accessible only at the age of 70 or 75 years. So the life cover extends for the entire term, which increases your premium cost. However, in personal finance, life cover is typically recommended only until retirement. At maturity, you receive the fund value, but by the time most of your financial goals would likely already be achieved. So despite the long wait, the potential returns are underwhelming. Even as a market linked plan, the returns from this policy is far below those of traditional debt instrument. Moreover, the sum assured is inadequate. So a combination of low returns, lack of liquidity and insufficient coverage makes this policy an unsuitable choice for your portfolio, and it also has a high agent commission. A better alternative would be a pure term insurance plan which provides affordable life cover to protect your family's financial future. For wealth accumulation, building a diversified investment portfolio is a more effective strategy.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.